Well, good morning and thank you for joining us. My name is Joanne Keane and I'm LIA's Chief Executive. It's great to have so many of you with us this morning for this joint collaboration with Mason Hayes Curran. And on your behalf, I'd like to thank Stephen Gillick for presenting this morning. So without further delay, I'll hand over to Stephen and I hope you enjoyed the session.
Thanks a million, Joanne, and thanks to the LIA for facilitating what I hope will be a very useful session. I'll try and cram as much as I can in the next half an hour. And just to let you know, the Q&A function is open, so please feel free as the talk progresses to enter any questions you have, and I'll deal with them at the end of the session, or as many as possible as I can. Okay. So pensions and COVID-19, what has happened to date and what can we glean from this and what are we seeing in MHC that leads me to think what are we going to see in the next 6 months or into 2021? Well, during the course of the pandemic, the Pensions Authority has issued several notifications, and the most recent event was where Brendan Kennedy was talking to the Society of Actuaries in relation to the activity of the authority and what it sees upcoming. The recent event, I suppose, was the recent announcement with the Society of Actuaries was most interesting in relation to the proposal, or not really a proposal, it's the way the authority is going to essentially categorize DB schemes into 3 categories in relation to how able they are to pay benefits. So that's interesting. What that practically means and how it will affect defined benefit schemes is difficult to glean. And obviously trustees will want to know what category their pension falls into of the 3 categories in relation to how able they are to confirm and perform their abilities to the best. The authority to date, I mean, if you look at it, what they've essentially said is it's business as usual. So they can't really take any action that flies against the legislation and the Pensions Act. So they can't waive any requirements, and they stated that. Now, they have stated that they will bear the current circumstances into consideration. How they do that is another question. But it'll be interesting to see whether this waiving of legal obligations relates to, let's say, communications or investment regulations. So it's going to be interesting 6 months to see how that actually washes through in relation to what the authority is able to do. And presumably we'll have further guidance on that. From the get-go, what they did say is, because one of the first actions with the pandemic was employers seeking to cease contributions into pension schemes. And they said from the start that they can't waive any obligation in the legislation in relation to the payment of contributions to defined benefit or defined contribution schemes, or what's in an employment contract in relation to an individual's obligation. The TWSS, so the Temporary Wage Subsidy scheme, that came in fairly quickly. And it was basically a top up from the state of individuals who were kept on the books of employers. How that knitted in with pension contributions was interesting, because in the revenue guidance notes on the TWSS, it stated that no deduction could be made from this. So you couldn't take a pension contribution from the TWSS. So how that worked in practice was in relation to, did an employee look at increasing their own personal contribution to the scheme to make up for any fall in the employer contribution, or did the employer look to make up that contribution themselves? Often the deduction in wage was corresponding to the deduction in the pension contribution, which all meant that there'd be less contributions flowing into all types of pension schemes this year. So that will have a longer term effect, and obviously the longer this goes on, and it will obviously wash through to the benefits available in retirement. It was interesting to see that the UK took a different approach to their version of the TWSS. So their TWSS did take account of a 3% auto enrollment contribution, and that was maintained in their TWSS. So if we do look at the pandemic continuing, will we see possibly a tweak or two of the TWSS to provide the pension contributions can come from that subsidy if it's continued, because obviously at the moment we're looking at winding it down. The first thing I think we looked at as a law firm in relation to COVID-19 was how exactly it would actually work in terms of trustee meetings. There was a lot of difficulty in that area because essentially, if you all remember back to March, chaos, well, organised chaos of a sort, started the day the schools were announced they were closing. So a lot of firms at that time took a decision to shut their doors and work from home. So that knitted into how trustees' meetings would function. And a lot of trustees required advice in relation to how the meeting could actually progress. Is it permissible under the trustee for trustees to meet electronically? Most trustees facilitated that. One or two required amendment to actually allow trustees to meet electronically, but these would be very, very old schemes. So the majority were all right. One thing we saw a lot of activity, and I think we'll see a lot of activity going forward, is in relation to data protection. Because data protection was a big issue, because we have Zoom meetings, we have team meetings, WhatsApp calls. There's a whole load of new kind of platforms that trustees are using that they may not be overly familiar with. So there's a potential for sharing documentation with an audience that's not intended. I've seen several Zoom calls that have gone wrong due to screen sharing and inadvertently sharing internal documentation and the like. So what I would caution currently and going forward is GDPR, data protection, and the manner in which trustee meetings are run. If you're sharing documentation, make sure that the platform is secure and that it doesn't expose the trustees or indeed life officers, investment managers, and other pension professionals to risk from sharing documentation. Statutory timelines, as the Pensions Authority flagged, timelines in the legislation, they're not changing. So there's no change to the Pensions Act whatsoever. There's no equivalent pensions emergency legislation. So all the timelines set out in relation to payment of contributions, issuing member reports, statements, etc., they are all the same. So irrespective of the practical difficulties that exist in perhaps getting these documents together, we're still looking at the timelines being in place. But that's an area that I think the authority will look at it in terms of giving a bit of flexibility. But once again, that's for the authority to confirm. Business continuity plans, this was the buzzword 3 or 4 months ago. So make sure you have a business continuity plan in place as a pensions professional, trustee, employer, and be sure that those that you're involved with and rely upon have a BCP in place. What I'd say now is look at those business continuity plans. How did they work for the first period of the pandemic? Do they require tweaking? It's no use having a business continuity plan from a pensions perspective if it is flawed in some manner. They constantly need to be looked at, and whether that's at a trustee meeting, whether it's an internal investment manager meeting, a life office, they need to be tweaked to really get them working in a manner which fits the circumstances that we're now dealing with essentially a pandemic that may stretch into next year and possibly beyond. So have a look at the BCP plan and tweak if necessary. The same applies for service providers. We're seeing changes going from service providers in many of the schemes that I act for. And the key element that I'm seeing employers and trustees wanting to be aware of is the business continuity plan and how that fits into the pandemic. A lot of the wording in service level agreements is old, it's pre-pandemic. And you can even see it in the Irish Times today, that a lot of life officers are now tweaking their documentation to ask COVID specific questions. The same has to be asked in relation to service providers and how the business continuity plans now can deal or have dealt with the pandemic. Contributions, I'm not going to labour this point. As I flagged, contributions to pension schemes, be it individual schemes, group schemes, what you're looking at, the 2 key documents are the underlying trust documentation or the letter of exchange that sets up the scheme. So what does that say about employer and employee contributions, and the contracts of employment. is the contract of employment specific in relation to a contribution or membership of a specific scheme? If it's more general, there's more leeway to move from a legal perspective. But if it's got specific language in terms of a contribution amount, it's often difficult to change that without the employee's agreement. So you can see in here what I've put is what we've seen from the DB schemes. So DB schemes, we've seen employers ask for contribution holiday requests. Several plans may have been under a funding proposal. They may have asked that the funding proposal be revisited as they can't pay the contributions specified in it. So we're seeing on the ground now a lot of defined benefit schemes revisiting the funding, irrespective of whether or not a funding proposal is in place, because often the employer is looking at the amounts going in and wishing to tweak these. Defined contribution and single member schemes, I mean, we've seen employers proposing to suspend or stop contributions. Employer members often request to suspend contributions. But once again, key documents. What do the trust documentation say in relation to suspending or reducing contributions? What's in the employment contract? So they're the two key docs that need to be looked. I've gone through this, but DB schemes funding obligations, it's very tricky to cease funding to a DB scheme, and often that can result in action from the trustees, whereby they may even lodge a contribution demand against the employer for the amount due to the scheme. So funding obligations, obviously, if you're a trustee of a scheme, you need to carefully consider any request from the employer to change the funding in a defined benefit scheme. And you may look, as the final point here states, look at contingent assets. So if there's a contingent asset, be it property or cash in a escrow account, you may need to look at that as a trustee to assist with the funding of a defined benefit plan. Investments, once again, I think we've learned as an industry from the financial crash in 08-09, where initially we saw a whole load of knee-jerk reactions, and this is something that the authority identified. So we've avoided that, it seems, this time around, and there's been a lot of careful consideration going into investment decisions in relation to the scheme. So avoid knee-jerk reactions. Safe haven scams, probably something that we've seen more in the UK. There's a lot of safe haven scams whereby individuals are coming up with all sorts of investment plans whereby they propose placing the assets in what's known as a safe haven, but the safe haven is crooked in some way in that it's not a properly structured investment. One thing that we've come across a lot is just due to the pandemic and actually acting upon investment instructions. So if you're a pensions professional and there's a delay in actioning any member investment request, this needs to be relayed to the members, probably even before they make the investment decision. Otherwise, you could have a whole raft of pensions ombudsman complaints in the future due to losses, because the stock market and equities are so unpredictable at the moment. There's a potential for either a high loss or a high gain to be unactioned on the scheme. One of the surprising elements, I think, and I'm not from an investment background, I'm purely legal, would have been the ESG performance during the pandemic. If you asked me in February, March, what was going to happen in terms of investments, I would have said there would have been a move towards the more stable investments whereby they have a longer exposure. So you'd look at investments such as fossil fuels and the like, whereby there's a longer experience in the industry of how these investments will deal with pandemics and the like. But ESG has surprisingly stayed the course during the whole pandemic, and it's done quite well as an asset class. So ESG, I think, has been one of the bright lights in the pandemic in how well it's done, and it's really outperformed what many in the industry thought would happen at the start of the pandemic. Final point on this slide, it's a bit bleak, but a second wave. So investment professionals need to factor in what will happen, because I presume there'll be a lot of queries in relation to how best to protect funds in the event of a second wave. And this is something that should be given consideration and probably looked at in terms of member communications, because this is something that members will be seeking advice on, I think, in the next few months. Debt and service benefits. Unfortunately, as with any events such as the pandemic, this is something that's going to be quite relevant. At the start, one of the initial queries was, will the policies actually stand up? Because many of the policies had an event or a catastrophe limit. That really hasn't played out, and I think most policies facilitated how the pandemic has played out. If the pandemic was far, far, far worse than it has, then perhaps these catastrophe and event limit clauses, whereby the payment by the insurance company is limited in the event of a catastrophic event, then we may have had a lot more inspection of those clauses. But as things played out, there was no real issue there. Something I have seen, and I think it needs to be really rectified, is in relation to letters of wishes, whereby a member of a scheme or an individual sets out in a letter to the trustees what way they'd wish to see their debt benefit paid out. These documents, it's important, I can't overstate this, that they should be retained. A lot of providers I'm seeing get letters of wishes in, the information's recorded on an internal system, and the letter is then destroyed. That is manna from heaven for lawyers, because then there's the potential to argue over what was actually in those letters. Was there an older letter? Is the recording correct? So it's very, very important that a letter of wishes or any document that sets out how an individual wishes their debt benefit to be paid out is either retained and scanned or the original document itself retained. Single member schemes. This is an area in MHC where we do quite a bit of work, and I've put in this slide just some issues in relation to single member schemes. Obviously, direct held property concerns, that's something with the property market, with the uncertainty involved. Is there an impact on scheme liquidity? The moratorium on rent increases, what issues will that have from pricing of assets? So single member schemes, they're not to be forgotten. There's real ramifications for what's happening in Ireland at the moment for those schemes. Going forward, I'd say we'll see a lot of service provider consolidation. We've already seen Willis Towers Watson, Aon merger. Will we see more? I think we will once the M&A market calms down a bit. At the moment, a lot of activity from a merger and acquisition perspective has been postponed or is slowing down simply because it's hard to get valuations of assets and companies. But I think we will see consolidation in the pensions market. You could even see during the week where there was activity, well, negative activity in the Goodbody and Fexco transaction, which has been parked. So it's interesting to see whether that will be rejigged again as we go further on this year and possibly into the next year. Because as I said, the main issue that's slowing this area down is the impossibility to actually value an asset going forward. Regulatory matters. IORP2, I feel I've been talking about IORP2 for the last year or so, but will we have implementing regulations for this piece of legislation? I'd say we will, now that we have a new government. The question is, what will be contained in them? And more importantly, will we see an exemption for single member schemes that has been sought by many in the industry? I'd possibly suggest that exemption may actually be in there, irrespective of, I think I've seen a lot of commentary out there from the previous minister and internally in the pensions industry, whereby there's a lot of competing interests. Some would like to see the exemption in place, well, many would, and then some would like to see the exemption actually come into play, whereby single member schemes are treated in the same manner as larger schemes. So it'll be interesting to see how that plays out. State pension age, this so we can see that the state pension age in the last general election was a big bone of contention. Now it's being postponed, the next raise, which has been commented yesterday by the fiscal committee, and they have commented that either one of three things has to happen: that PRSI has to increase to pay for a more expensive benefit, that the benefit itself, so the state old age pension, has to decrease, or the retirement age has to increase. So we're seeing a pause on the retirement age increasing. So you presume one of the other two options that I mentioned would come into place. So either the benefit will decrease, which may happen because the state old age pension in Ireland is generous compared to our European neighbours, and PRSI increasing. So you may actually see a combination of both of those. Auto enrollment, well, we're looking at auto enrollment coming in. I think at some stage, someone is going to have to grasp the nettle, and auto enrollment is coming in. 2022 was the original plan for the rollout. There's no way that is going to happen now at the moment. I think realistically, you'll be seeing auto enrollment perhaps 2025, something around there. But there was a commitment made in the programme for government Fine Gael and Fianna Fáil. So I expect to see auto enrollment being rolled out in the future. And that's it for the presentation. So I'm just going to go to the Q&A section, and if anyone has any questions, feel free to feed them in, and I'll do my best to go through them. So the first question is, what changes can you see to auto enrollment when it's eventually rolled out in Ireland? Well, I expect to see that possibly that auto enrollment, the contribution rates might be lower than those that were speculated. So I think AE might come out, but the contribution rates will be very low at the start, simply because individuals, be it employees or employers, don't have the funds to actually pay into auto enrollment, and also the infrastructure to provide auto enrollment is going to be very expensive. So I think the contribution rates might actually be lower than those that were floated during the initial period. Okay, will the effects of COVID-19 on pensions remain after the virus has gone? Yeah, definitely. I think, as with every industry, COVID-19 has had a massive effect. I think you're going to see various issues such as ESG. I think ESG has received a massive boost through its performance in the COVID-19 area. So it's going to be something that washes through for many years to come. I think trust documentation of pension schemes is going to have to change to take account of how COVID-19 has worked out, be it trustee meetings, be it the actual practicalities of a scheme, investment decisions, various other nuances that we've seen, queries coming in. I think there's going to be changes from a practical legal perspective, but also various changes to take account of how COVID-19 has made the operation of a pension scheme clunky, let's say, during the pandemic. Okay, you referred to contracts of employment and references to compulsory employer contributions. But what if contracts also refer to employee contributions being compulsory matching, but employees are in receipt of the TWSS? How can an employer match what cannot be paid? A lot of it depends. If it's in the employment contract, what I'd say is, first, there has to be a discussion with the employer, with the employee. So if there's a stipulation in the employment contract that you are entitled to X% and the employer will pay Y, and the employer says, we cannot do this, I think once the employee is understanding, and especially the circumstances over the last few months, what we've seen from a legal perspective is that there's a discussion with the employee. There isn't a change in the contract, but there's email and other correspondence between HR and the individual saying, your contract says this, but due to the TWSS come in, the contribution is going to be Y. So the employee contributions, unless you decide to pay ABCs to bring the amount up, will be reduced to a corresponding amount. So I think it all comes down to a discussion rather than a unilateral move from the employer. Okay. Have you or any of your trustees come across any issues transferring risk benefits? Okay, so transferring risk benefits. I take it that this means risk benefits that are being paid to an individual. So if they're entitled to a spousal pension, that they transfer this or agree to substitute it in terms of a higher lump sum payment. Yes, is the answer to this question essentially. Now, it needs a bit of clarification, but it comes down to, are you amending the underlying trust documentation of the scheme? Are you, once again, are you amending a provision in the employment contract? If you are, then there are issues because you need employee consent. There's very little that can be done unilaterally in terms of a pension scheme. You either need trustee buy-in or member buy-in from the employment law perspective. Okay. Are there any delays in the issuing of pension adjustment orders in the current environment? The delays from this perspective, I think, are in relation to the courts being closed. So I'm not a family lawyer, so I'm not sure what the family law courts are, if they're open at the moment. So central office, where the PAOs are filed, so you've got various issues. Central office opening hours, court opening hours. Do you have actually drafting the pension adjustment orders and serving it on the life office? There's all sorts of procedural issues that could result in a delay in a PAO at this stage. I think they can all be worked through, but once again, there have been no changes, as far as I'm aware, with the Family Law Act and all the deadlines that are set out in the pensions legislation. So there's no change from a legislative point of view. The changes and the delays may flow from a practicality in terms of the offices and the courts being open and serving it on life offices who have to then look at it, essentially examine the PAO, because sometimes the PAOs, unfortunately, what I've seen is they're prepared off a stock template. And I've seen PAOs which are essentially Frankenstein's monster, which have the wrong pension scheme number, incorrect names, simply because they're using an old template. So often it's down to the life office to review this, go back to the lawyer who's drafted it, or indeed the member if they've drafted it off a template, and say, this needs to be tweaked in order to be effective. Okay, if an advisor recommends reducing risk following the market fall and recovery to protect pension values going forward, but markets continue to rise, could the advisor be in trouble? I mean, it's just like a normal, we're in unusual circumstances, but normal business remains in terms of advice to an individual. There's individuals out there far more qualified to comment on investment decisions to be made in schemes. The important thing is to look at the trust documentation. Is the investment decision permissible under the trust or letter of exchange or whatever documentation set up the scheme? Secondly, timelines you've told the individual for investment decisions, are they still working, or is there going to be a delay? Where the advisor is going to be exposed to a delay, if you give a member open, transparent advice in relation to investments and allow them to make a decision, if they're able to make a decision under the rules of the scheme, you're relatively protected. But what I would say is, if a member, and I've seen it in practice, where a member wants to the investment decision action that afternoon, if this isn't going to happen for several days due to practicality, then you could have issues. So, because if the investment decision was sent by email on a Monday, wasn't action till Thursday and resulted in either losing a gain or gaining a loss, then you're exposing yourself to massive issues. Okay. I joined late, so hope you didn't cover this. Budget impact, pensions levy, reduction in SFT, change in 115k limit. I haven't actually heard anything being proposed either in the July stimulus or the budget yet from a pensions perspective. Obviously, the one that grabbed me was Sinn Féin's election manifesto, whereby they wanted the SFT vastly reduced. But I haven't heard talk. The main political football at the moment in relation to pensions between the parties was concerning the pension age for the state pension. In the realm of private pensions, there hasn't really been anything mentioned in relation to a pension levy. I can't see there's an appetite for that. The industry was hit very hard by the previous pensions levy, and I haven't heard any talk about a new pensions levy or a reduction in the SFT or a change in any limits being mentioned. But listen, the times we live in, I think everything's on the table. Okay, will Pensions Authority give some leeway on statutory reporting? Yeah, I think that is the area where you may see the Pensions Authority give leeway. The Pensions Authority may, I don't want to speak for them, and obviously I can't, but where I'd expect leeway would be, say, the preparation and circulation of members' benefit statements. So if there's a delay in providing those documents to individual in terms of timelines and legislation, that would otherwise expose a trustee or an employer to an on-the-spot fine, that in recognition of the circumstances we're living in, especially during March, April, May, that there would be some leeway there. But we're waiting on guidance from the Pensions Authority. Where are the pension simplification proposals at? PRSA transfer certs of a comparison requirement to stay. In relation to the PRSA query, I don't know is a simple answer. Pension simplification proposals, what I'd suggest is there seems to be a transfer of a lot of individuals in the civil service. I presume that is being unravelled now during the crisis, and a lot of the work in terms of pensions was bumped down the list. So I presume that the pension simplification proposal, and especially the tax simplification that we're looking at, that's been bumped down the list too. But it's still something that must be done. I know they wanted to do it with the whole AE and perhaps master trusts as well. So it's still on the table as far as I know, but probably bumped down the list. Okay, if IORPs include one member, how can they fit in with proportionality requirement under the directive? Can trustees object to the rule? Okay, so if IORP2 doesn't contain the derogation, it'll be very, very hard for one member schemes to adapt. Definitely the current one member schemes, but one member schemes into the future, it'd be hard for the current model to adapt. So how will they fit in with the proportionality requirement under directive? I don't know is the answer. I think a lot of people are hoping that the one member schemes continue to be exempt under IORP2 as they are under IORP1. And this isn't something, I don't think there's been a lot of thought given to how single member schemes may adapt if the exemption isn't given. I think a lot of schemes and a lot of providers in the market are adopting a wait and see attitude. Okay, is the threshold for accessing ARS at 12.7 likely to remain after COVID-19? Will the threshold mirror the state pension? Once again, a short answer, I don't know. I haven't heard any talk or any whispers in the wind in relation to changing limits. So unfortunately, that's an answer. That's the best answer I can give in that question. Is there anything to prevent annual benefit statements being emailed to members where addresses are known as opposed to having to be physically posted? Unfortunately, there are, because there are issues in relation to this, because you have to have consent from an individual, and this may be changed by the IORP2 legislation as well. So once again, this is a moving feast, but you have to have an actionable consent from an individual to accept electronic communications, and this it depends on how this is worded to the individual. So the individual has to not opt out of receiving paper communications, but opt in to receiving electronic communications. So it comes down to actual communications with the members. Okay, unfortunately, I've been told we're near the end, so I'll take one or two more questions. And then I will have to leave it. Your comment around the state pension and the idea of an increase in PRSA or the payments going down to maintain the benefit and with auto enrollment on the horizon. Is there any idea in terms of the tax relief available on PRSI contribution to the pension? No, there isn't that I've heard of. I know, I think it was yesterday or the day before, that various interested parties had a meeting and a call with Leo Varadkar in relation to what could be in the July stimulus package. don't know whether there was any input from a pensions perspective, but my comment in relation to the state pension was essentially that one of three things has to happen. Either the state pension age has to go up, as was the original proposal. That looks to be parked. So you've only got two options left. So increase PRSI or reduce the benefit. And you're probably looking at a tandem approach to that, albeit it would probably be easier to reduce the state pension, but that would not be something that would be very popular with a new government coming in. So it's very tricky, and I'm glad I'm not a politician who has to make that decision. Will this presentation be available for us to access afterwards? I joined late and would like to watch it again. My immediate response to that is, I think it is. I think it will be circulated, and if it isn't, certainly feel free to either email myself or Joanne, and we'd be delighted to send off the slides. And that, unfortunately, is where I will have to leave it. I've been told I've run over time, but thanks a million for attending today. I hope it was useful. Sorry, I know there's a few questions that I didn't get to read simply because I ran over time. And I'd love to hear from anyone, positive or negative. If you have any questions, feel free to fire me off an email, and we'll leave it there. And thanks a million for your attendance, and have a good day.